Okay, so handout 14 is all about costs of capital for entities and associated tax shields. So let's, as usual, as they say, jump right in. Okay, so again, we're interested in cost of capital for entities in this chapter. So not the financial project. Should we buy this bond? Should we buy 5 shares of this stock? We're an entity and we're thinking about our cost of debt capital, our cost of equity capital. We're thinking about buying a whole firm and what's the cost of debt capital or equity capital. So we'll call RD our cost of debt capital, RE our cost of equity capital. And we've got here two main measures of our cost of debt capital for entities. Let's focus on cost of debt capital for a little while here. So the first one is pre-tax, and that does not include any income statement effect with tax. It does not include what we've started to call the tax shield effect. The second measure of cost of debt capital for entities is our post-tax cost of debt capital. And this is going to include the effect on the income statement of tax. Okay, and this is called the tax shield effect here. So first, let's beat to death, as usual, our pre-tax measures of cost of debt capital, and then we'll do the same thing with post-tax measures. So in general, if we're just looking at one project, like we're going to issue one bond or we're going to get one loan or something like that, the cost of capital for that project is its internal rate of return using all of the promised contractually specified cash flow. So if we're the CFO of an organization, we want to use the promised cash flows because we're not thinking, well, there's a probability we're going to go bankrupt, right? If you're the CFO, you're hoping you're not going to go bankrupt. So it's all about the contract for you, okay? And just as a reminder, the IRR for the project is the discount rate that makes the NPV equal to 0. Using the IRR is important because if there are fees associated with issuing a bond or getting a loan, they won't be captured in the interest rate that's quoted in the contract documents. But the IRR, remember, includes every stinking cash flow. So that's going to include the increased cost of capital due to fees and stuff like that. Okay, so most entities, I would even dare to say, have more than one debt contract obligation. So what do we do if we have a company with some bonds, some loans, stuff like that? How do we get their pre-tax cost of capital? It's just the weighted average for all their debt contracts. So for, let's say, loan number one, RD1 would be the IRR of that project, including all the fees and all that, times the amount of principal they borrowed there. And same thing for project two, get the IRR of that times the amount of principal there, et cetera, divided by the sum of the total principal of debt that they have outstanding. And there's an example down here I'm not going to cover again, but we covered that in class, and you've done things like that in homework, and you'll probably see something like that again on the final exam. So what if we have, a lot of times we might be an analyst looking on the outside in, or we might be working for our company's CFO who wants to know, should we buy this other company? Should we think about taking over this other company? And we haven't told the other company about this yet. It might be a hostile takeover. So all we have to look at is the publicly available financial statement. So we can do a pretty good job in that case. And it's very simple. The pre-tax cost of debt capital, if all we have is financial statements, is we get interest rate, and you want this to be annual interest. You want it to be annualized, right? Measure time in years here. So I'll make that just to be super clear. And you will okay, annualized interest in the period divided by total debt, BOP. BOP is very important because this is answering the question, given the total debt you had at the beginning of the period, how much interest did you pay on that? So there's a little example here where we have 2 years of balance sheets for a company, and we have 2 years of income statements. And if we want to get the pre-tax cost of debt capital for this company for year 2, it's going to be the interest paid in the year divided by that beginning of period total debt. Remember, balance sheets always happen at the end of the period. So end of year 1 is beginning of year 2, and that's why I'm using 3,000 and not 4,000. So next up, let's beat to death post-tax measures of cost of debt capital. And what we really want to consider for the company is the net impact of this debt on their finances. And we have this benefit of debt that it does reduce taxes, typically, not always, but usually. So this is going to benefit the entity by, once we've reduced its tax, in turn, that's going to mitigate the impact of the interest payments on net income. And so here we have another example. And yes, I did make the cardinal sin here with you all, changing my units midstream. As you know, I try very hard not to do that on homeworks and class assignments or exams, but this is just dollars up here, and this is thousands of dollars down here. So where are we with all this? I want to show you how the tax effect works here and the benefit that we're getting from the post-tax cost of debt capital. So we've got the company operating with no debt, and they have earnings before tax of $850. But if they take out this big loan, they pay 10% interest on that loan. They're going to have to pay $100,000 in interest, so they're going to have lower earnings before tax to the tune of $100,000. Their tax rate is 50%, okay? And because they have this additional expense, they have lower tax there. And they do have, yes, it's true, they do have lower net income, but because they paid less tax, check this out, they pay less tax because that debt is treated as an expense that they can claim on their tax return. So since they're paying less tax, the hit to their net income is only $50,000. They have a tax rate here of 50%. Okay, so the key point I want to get to here is that in general, the effect of debt interest on net income goes like this. The change in net income from having no debt to having debt is not just the interest rate expense, but it's less than that. It's 1 minus the tax rate times the interest expense. And the fact that the hit on net income is not equal to just the interest expense, but it's less, 50% less in this case, this is called the tax shield. And in general, the tax shield increases ROE. So that's a good thing. And we looked quickly in the lecture, and I thought it was worth bringing up again how way back in the early days of the course, we looked at the conservatives versus the cowboys when we were doing ratio analysis. And what we saw was, well, we saw that the ROE for the highly levered cowboys was scandalously high compared to the conservatives with no leverage. We see we have no interest there versus a big bunch of interest. But the change in the Cowboys' expense was $9 million, but their net income was only decreased by $6.75 million. And how did I get that? You could work out the numbers directly from the income statement or use the little formula in red on the prior page to get, we have our interest here of 9 times 1 minus 0.25. The tax rate for them is 25%, and we get our 6.75. And then again, just as a reminder, in good times, when you are levered, it increases your ROE. All right, so now on to cost of equity capital. So this is sort of a problem because the cost of debt capital is relatively easy to estimate. We saw some methods to use. They're all related to contractual terms one way or another. And as long as there are no defaults, we're gonna nail RD, pre-tax or post-tax, perfectly. No ifs, ands, or buts about it. Cost of equity capital is a whole other story here because now we're interested in the growth rate of an investment with no contractual term. So we have nowhere directly to look for this. So always our cost of equity capitals are going to be a rough estimate, and they're going to be affected by macro industry management sort of issues. So given that this is a tough problem, which probably means we're going to have crummy models using to help solve this problem, what are some of the ways that folks estimate cost of equity capital? Great survey done by Graham and Harvey in 2010 for investment banks and hedge funds found that most of them used this capital asset pricing model method, and a bunch used historical average returns. Some used modified Capim, which just has some improvements built into it. And some use this thing called the Gordon model we don't have to worry about now. And I love this, whatever investors tell us. That's just great. That's the type of firm you probably don't want to work for. Okay, but as you can see, there's a very, very heavy use of the Capim model. These add up to more than 100% because firms, smart firms especially, use more than one method. But Capim's used a lot, so we gotta use it. So let's talk about Capim. Capim is our best known, most widely used model for equity cost of capital. Could be used for RD, whatever. You should know that it's limited in application and inaccurate. And I've given you some good quotes on this from some pretty good sources. So we all know that Capim is not so great, but we use it anyway because why? Because it's a nice, easy model to put into a computer. I'll show you that in just a second. So the Capim model says if we're using a DCF method, such as NPV, to evaluate an equity project, like buy the company, do we want to buy this company? We use our NPV method, and we want to discount here with our equity cost of capital. So whenever we have something like this, we're trying to value a company for owners, something like that, and we need to discount with the equity cost of capital. The Capim model says the equity cost of capital to use comes from this equation, where you know now all the things in this equation. This is our risk-free rate that comes from treasuries. This is our market rate, which is the expected value return of the stock market. And this again is our same risk-free rate measured by treasuries as over here. And beta is the correlation and amplitude of returns from a regression of the company we're looking at versus the stock market. So here are all of the definitions in long form in case you want to spend a little more time with them. Okay, but let's just think a little bit, make sure we understand completely all of these components. The Capim model measures risk in three pieces. Risk-free risk, measured by risk-free rates, which we typically look up via treasuries. Broad market risk, which is RM. And then the third piece is that correlation and amplitude of the, really, we could say, entity J's returns compared to the market or the industry. So this again comes from our regression analysis of entity J versus the market. So Capim model has risk in three pieces. One thing we're going to use, as you've probably seen by now, for the rest of the term is that we have to understand this concept that as an entity's financial leverage increases, as its debt increases, its beta increases, and that's going to directly increase RE, right? As beta is getting bigger in this equation, RE is getting bigger. Bigger beta, bigger RE. That makes sense. The more leverage we have, the more risk the shareholders are taking, and so the higher cost of equity capital they should demand. Okay, the gory mathematical details come from Hamada's equation, which you do not have to compute in this class, but you can look and see how it works mathematically here if you want. So if we look at the beta of a firm with no debt, or if we pretended that it had no debt and looked at it that way, that would be called an unlevered beta. Okay. And how do we get our beautiful inputs for the Capim model? Well, like we said, for the risk-free rates, where treasuries are a good proxy for risk-free rates. So we go right to treasuries for that. For RM really is the expected value rate of return on the market. So just go out there and get 30 years of returns of the S&P 500, take the average, and blammo, you've got it. Also, though, however, you should know a lot of people, instead of estimating RM, they estimate this quantity, which is the increment of risk of the market over the risk-free rate, or what we like to call the stock market risk premium over the risk-free rate. So a bunch of self-declared intellectual worthies have had the temerity to make such estimates recently. Latest study I could find was 2018, and this was when GDP was really high. So things change obviously from year to year. But someone at Goldman estimated the risk premium at 3%. Someone from Wharton 4.2, et cetera, et cetera. And so here are a bunch of estimates. The interesting thing to see here is the huge range of these estimates. Okay, and then how do we get our correlation and amplitude piece? Once again, we do that from the correlation of the returns of the company we're looking at to the returns of the market. We just do this linear regression, and the slope of that regression line is beta. And you want to make sure when you do that, you use at least 30 return periods if you can. Okay, and that is it for our handout 14.